Hey everyone, I'm Lee Mackey, a partner here at Mach 1 Financial Group, and I wanted to spend a little bit of time going over the December market update. As many of you know, we're still in the throes of a bear market. It seems like it has been a while since we've had some positive news to report on the market front. But let me go over first some market information, and then we'll kind of get a little bit more specific of some things that we're doing here at Mach 1 in your accounts. Last week was a fairly good week in the market. The stock market indices all finished higher for the week. For the numbers year to date, the S&P 500 is down a little over 13% year to date. The NASDAQ has almost doubled that down, and the NASDAQ is down almost 26% year to date. And then the Dow year to date is only down 3%. If you want to go back a full year, a 12-month period, the S&P 500 is down almost 10, the NASDAQ is down about 25, and the Dow is actually positive about 2. So, and these are numbers through the end of last week. What does that tell us? A couple things. One, we are still in a bear market. Oftentimes in bear markets or in correction periods, the markets can rally, and they have done that over the past few weeks. Now, this week, as many of you know, the markets have trended lower, but we are still in what's considered a bear market, and we may be in that for some time. Doesn't mean the markets can't rally, and they will. The markets will continue to go up and down. We believe that for the next little while, for the next few weeks, several months, the markets will continue to gyrate up and down, until we get a firm footing, until we get some guidance that will lead the markets on more of a sustained move higher. We believe, through our research and working with outside partners, we believe that we are in for a period of higher interest rates, higher inflation. We do feel like inflation has peaked. We do feel like that interest rates as well maybe have peaked. We do feel like the Fed is going to continue to raise interest rates, albeit at a slower pace. But we do feel like that with inflation peaking probably a couple months ago, that they will begin to slow the rate of their interest rate increases. We do anticipate another 50 basis point rate hike next week, and then continuing into the early part of 2023. With that said, because inflation is going to be with us for a while, because interest rates are going to continue to be high, we feel like a shift to a more defensive posture is necessary. We are preferring value investments over growth investments at this time. We are looking for high quality, strong balance sheets, very good cash flow, dividend paying companies to invest in. And so many of you have seen changes to your portfolios to where we have made that shift to a more value-focused portfolio, and we will continue to do that over the coming weeks and months in preparation for what we feel like will be, kind of a rough go in 23. We don't necessarily think that we're going to have a continued sell-off like we have in 22, but we do feel like there's going to continue to be choppiness, volatility, until the markets get a signal from the Fed that they are done with their interest rate hikes. The Fed has one mandate, or basically two, but the Fed's primary concern now is to get inflation under control. The Fed has made it very clear that, if they had to choose between tipping the economy into a recession or letting inflation run hot, they're going to tip the economy into a recession. We don't know yet whether or not a recession will occur. I think that most people believe that one will happen in 2023. Our feeling is that one will occur, but it'll be shallow. It will be mild. It's not going to be a recession like we saw during the financial crisis of 2008 and 2009. This is going to look a little more benign. We do feel like that the unemployment rate will kind of move from where it's at now, around 3.5%, up to 5.5% to 6%. The Fed wants the economy to slow down, and they're going to do whatever it takes to make that happen. Along those same lines, we're not leaving growth. We still like the growth sector, the growth positions, but we're going to underweight those as it relates to value. Fixed income. Many of your portfolios, we're introducing some fixed income to our portfolios. That's a little bit of a shift from what we've done in the past. We are staying on the short end of the yield curve, meaning that we're not going out and buying long-term bonds. We want to stay very short in the 2 to 3 year range and below. We feel like that's where the value is. So we're going to stay very, very short when it comes to fixed income. We want to get paid while we wait. And so from a combination of interest payments on our fixed income, dividend payments on our equities, we want to generate some income while we wait for the markets to improve and then to have a more sustained upward trend. So that's kind of our makeup of the portfolios. Like I said at the beginning, you're going to continue to see us make these changes over the next several weeks, several months to better position all of our clients as we head into the new year. Let me give a building update. Many of you are aware that we are moving to a new location soon. We have been given the green light from our contractor that towards the latter part of January, third week or so, we will be able to move into our new building over on 52nd Street in Rogers. We are excited. Our space will be almost tripled from what we're at now. I know that the entire staff is ready to have a little more elbow room, but we'll be giving you more information on that in the coming days and weeks, but it'll be here before we know it. We will be having an open house at our new location sometime in early March, so be watching social media and your emails for an invitation to an open house that we will be having in that first week or so of March. Many of you received a survey from us in the fall. From Nexa, we asked a number of questions about how we're doing as a firm. We just received the results in from those of you that participated in the survey. And for those of you that did complete the survey, we want to say thank you. We have just received the results earlier this week from Nexa. David, Matt, and I are going over the results, and we are going to act appropriately and accordingly on many of the suggestions that were given. There were some concerns that were expressed, and so we want you to know that we have got the results in just in the last couple days. We're looking at them, and then we will address everything that came up in those results in due time. But again, thank you for participating. We want to be the premier investment firm, financial services firm for you, our clients, and the only way to do that is to listen to opinions that you have and strive to be better each and every day. So thank you. As we enter the holiday period, things are hectic. You're out doing your Christmas shopping, making final to-do lists, hosting family and friends. And so on behalf of David, Matt, and myself, and the entire team here at Mach 1, we wish you and your family a very, very Merry Christmas and a wonderful start to the new year. Have a great day.